Hello and welcome to the CNBC TV 18 special. I'm Shireen Bhan and we're coming to you from the magnificent Franklin Templeton campus in California. Joining us now for this special conversation is Jhaveri, the Managing Director and Portfolio Manager of Franklin Local Asset Management Group. We appreciate you joining us on CNBC TV 18. Of course, you're an old India hand. So let me start by asking you about what the sense is about India, the strength of the India story, the strength of what the government is attempting to do to try and push reforms. The finance minister is here. You're going to be meeting him as well. Are people excited or continue to be as excited as they were 12 months ago about India?
Yes, I think the real difference in the last 12 months has been that when the Prime Minister took over, basically India was, in our view, a relatively weakened economy. A lot of things weren't really in its favor per se, but investors were very optimistic of where things would go. So from there, if you fast forward 12 months, you have investors with a mixed bag of feelings. I mean, some of the momentum investors are out of the market. Some have made money. They're the long-term players like us. But in the meantime, the economy has got much stronger. So whether you look at the current account deficit, the fiscal deficit, you look at inflation, and a lot of other parameters we track, everything looks so much better than it was a year ago. So for us, as long-term investors, we like fellow long-term investors which come in. So this current market weakness for us is a great opportunity to, one, relook at the stocks we like with our teams. Plus also just, we look forward to other long-term players come in as well.
So are you seeing this correction as a point of re-entry into the market? Or to accumulate the stocks that you already have?
Well, I was seeing some clients over this last few days, and what we're telling them is the same, that you have to look at India as a 4 to 6 year structural story. There's a cyclical improvement coming through right now, which you see in some of the numbers, and more will come. But the real
not in the earnings just yet.
Exactly, and that's the thing that people were pushing back on, and we agree that earnings have not been as good as people expected them earlier for a host of factors. A lot of that being the trickle-down effect of commodity prices weren't fully felt through. Many companies are now using the lower interest rates to refinance their debt, which is a process that takes time. And then the Indian equity markets are also allowing some companies to raise capital at what they would think are good rates right now. So that would lead to hopefully a better earnings recovery going forward. Historically, Indian earnings have grown at 10%, or double digits over time. And I think they came down to low single digits. So in that sense, there is a time when those should turn around. If you look at corporate margins in terms of EBITDA, ex-refiners, we are seeing improvement there as well. They seem to have bottomed out. So corporate India is slowly getting ready, I think. So India, the economy as a whole, is looking better than it did a year ago. Corporate India is still to show some of those, but I think we are getting closer to a time when some of the earnings numbers, as they start coming out, would ratify our sense that things are getting better on the ground.
So what do you make of the current volatility that we're seeing in India? I mean, it's being attributed to all kinds of things, a little bit of profit booking from investors putting money into markets like China, where the markets are currently moving higher. Of course, the past week we've seen China come down and India's actually been able to move back up a little bit and recoup some of the losses. But what would you attribute the nervousness that we seem to be seeing and the volatility that we see in the Indian markets of late?
Well, so as you know, the domestic investors have been a very steady hand for the last few months. All our funds, including across the asset management industry, have seen steady inflows coming in. So that has been a good bedrock for support. Foreign investors, you have to remember, unless they have dedicated India funds, have to choose between India and other emerging markets or other opportunities they have. And yes, with the Chinese market showing strong performance during a large part of last year and this year, has forced many EM investors to think about a place that they were strategically underweight. They might have transferred some money over there. And then corporate earnings not being as much as they expected maybe led to that as well. I think going forward, if you look at even China per se, where the economy is not growing as fast as it was for a host of reasons.
Not in the best of its health.
Not for a host of reasons. What you see is that the stocks that are really gone up, if you look at the China Next Index and some of the Shenzhen Index versus the Shanghai, a lot of these are the internet stocks, or some of the technology companies. A lot of the participation is largely retail, but also many manufacturing companies in China. We just see more and more anecdotal evidence that some of that company management itself has been trying to look at invest in the stock markets, especially companies that are owned by sole proprietors. They have spent more time in the last 3-4 months investing in a Chinese market themselves, with the goal that we'll make more money and they'll bring that back into our businesses. Now, we learned as kids a game of musical chairs, and we know how all that ends eventually. So we hope there are enough chairs left for all the people who are playing this game.
Well, that's
it's a bit difficult in our sense. But when you ignore all the froth aside and look at the true fundamentals, India compared to China offers so much more. We have I think if you look at private sector companies in India, we have a very long history of management there. Indian ROEs are far stronger than China. return on equity. And that's because capital was scarce, so only the best projects found the light of day historically. And we hope in that sense this market corrections and the general access to money, we do like it when it's not very easy, because that would mean that you don't see weak projects see the light of day, only the best ideas shine forth.
Sure.
So in that sense, we appreciate markets like these, which are actually helping us and also helping investors really look at the valuation. So just like the US, if you see where people keep asking us, since you're based in Silicon Valley, what do you think of the technology and the markets, and is there a bubble or a fraud? And our sense is, as long as good companies are able to IPO and bad companies are not, then the markets are still rational. And that's what we're seeing in the US as well.
The finance minister here making a pitch, I understand, to pension funds, the likes of CalPERS of the world, to come and look at investing in India. We've allowed FDI into things like railways. We're looking for FDI into the port sector, for instance. But do you really see new capital coming into India, specifically in the infrastructure areas, and really long-term money like that?
I think it should be. You've seen, you mentioned CalPERS, and like CalPERS, there are many other pensions and university endowments who do have a horizon which is beyond the average
endowments is another catchment area that I understand he's going after.
Absolutely. And from our meetings with some of these endowments and pensions, they do have an active portfolio in the long-term private equity space. India always is a very attractive destination for them, because that long-term unlocking of the entire infrastructure space matches their horizon. And in some sense, there is still a lot of other places, private equity, from what we understand, they're chasing very few deals, a lot of money trying to really go after a few really attractive businesses. In India, you still have this situation where a lot of money wants to come to India, but also India can take on even more money in that sense.
So what kind of money are we talking about? I mean, how large could the quantums be?
I mean, if you look at some of these large endowments, and some of them are upwards of $50–60 billion each, some of the larger ones are 150–200 billion. You're not even talking of the sovereign wealth funds, who would have a similar attractive interest as well. So for us, I mean, and for other clients of ours, India offers opportunity on private equity, public equity, fixed income, and everything else per se.
And you think it's just a question of when they will write the check? It's not about triggers that they're still waiting to be convinced on?
Well, it's a long process. If you look at any government trying to make changes to an economy, some of them are instant and quick. Some take the wherewithal of various other political elements and other participants in the system. So India, in that sense, needs to get a few things right. I mean, the government is talking of maximum governance and minimum government. It's talking about a lot of other things, including, more red carpet, no red tape. And as bureaucracy and as politics aligns with India's economics, and as more participants in India in the political space really put on their Indian hat first and the political hat later, you would see a lot more fast tracking of a lot of this money that wants to be in India and really grow with India.
Okay. Outside of the infrastructure play, where we really do need significant sums of money, and even though the public sector or the government, via the public sector, is trying to kickstart investment in infrastructure, specifically through the roads and railway projects that hopefully will get off the ground. But where else beyond infrastructure do you see people excited about India?
I think the consumption space and the saving space and the financial instruments and the financial products that we see in many developed markets, all that's the exciting space. If you look at India and China, again, the populations are similar. Once you cross 1.2 billion, what is 1.3, what is 1.2? They're kind of very similar. But at that stage, the average median age in China is 37. The median age in India is 27. So you have a far younger population. More than half of India is under 25. And which just means that as they go up the income track and you start having more wealth percolate to the masses in a way, you'd see more consumption for sure. But you also see finally some real serious savings for the long term. And which would mean all the financial instruments that are there, wealth management products, insurance, everything else becomes far more important. And there are many private sector players in that space that really would have a great distribution network, the skill sets required to grow in that space, not just lending, but the entire fee-based service business, which we think is really set to grow at a fast pace.
Since you spoke about insurance in specific, and that's one area where this government has finally managed to push the FDI limit beyond 26%, do you see interest from new private players, global private players, to look at joint ventures in India to enter India at this point in time?
Logically, there should be. What we have been telling a lot of players that do ask us, because we've been in India for so long, that they say, like, how do we play India, how do we start? We do tell them that you have to start now. You can't think about 20 years from now when the market is big enough. You have to seed it when things are small. It's like wanting this shade of the tree we are under. And we didn't plant it yesterday, right? It was 20 years ago. So it's the same with these companies.
Why are they still cautious, or what are they concerned about?
I think a few reasons. One is, there is still a lot of clarity required in terms of what does it take for them to set up business and to grow. And, all these restrictions of various foreign caps that we have, if there is no path to 100% ownership or some paths to complete control, it's hard to commit serious capital.
So the control issue continues to be a constraining factor.
Because, that is something I think a lot of players would like to have an equal say in how their brand is used and how the business is rolled out. And sometimes you get great partners and the shareholding doesn't matter so much, and sometimes one does need them too.